Today, we're tackling one of the biggest, most fundamental questions in all of finance. How do companies account for revenue on these massive projects that can take years, sometimes even decades to finish? Now, this isn't just some boring accounting theory. This is about the very architecture of how we measure a company's success.
All right, let's just jump right in with a puzzle. Imagine a company lands a billion-dollar contract to build one single, super advanced fighter jet. The whole project is going to take 10 years. Now, in year one, they've spent millions on engineers, on materials, but the jet is, it's basically just a frame. It's nowhere near done. So here's the question. How much profit can they legally report to their investors that year? Is it zero? A tenth of the total? The answer has huge implications, and it's exactly the problem we're going to solve today.
You see, this isn't just a thought experiment. It's a core financial problem that for a long time was handled by this messy patchwork of different rules for different industries. But not anymore. Now the entire world has basically unified under one powerful framework. In the US, it's called ASC 606, and internationally, it's IFRS 15. But don't worry about the numbers, they both have the same goal: to answer that fighter jet question in a single, consistent way. So what's the secret sauce? What's the big idea? Well, the modern answer to this whole timing problem comes down to one single word: control. The new rules completely shifted the conversation. It's no longer about risks and rewards. Now it's all about one simple question. At what point does the customer get control of whatever is being built? If you can understand this one concept, you've unlocked the key to the entire system.
Okay, so how do we figure out when that control has actually been transferred? Well, accountants have to follow a mandatory process for every single contract. I want you to think of it like a train journey. There's a set route with 5 mandatory stations that you absolutely cannot skip. And here's that route map. First, you've got to make sure you have a real, legit contract. Second, you figure out exactly what distinct promises you've made to the customer. We call these performance obligations. Third, you nail down the total price. Fourth, if you promised more than one thing, you have to split that price up between them. And then finally, we arrive at our destination, step 5, the big one, where you actually get to recognize the revenue.
For a long-term project like our fighter jet, this is where the track splits. Step 5 forces a huge choice. Is the company going to recognize revenue gradually, piece by piece, as the jet is being built? We call that recognizing revenue over time. Or does it have to wait 10 years until the jet is completely finished and then recognize all the revenue in one giant lump sum? That's called point in time.
So how do you get on that over time track, which is what most big companies want? Well, here's the interesting part. You only need to meet one of these 3 criteria, just one. The first one is mostly for services, like a cleaning contract. The second one, that's perfect for construction. If you're building a house on the customer's land, they obviously control the asset as it's being built. And that third one, it's like it was written specifically for our fighter jet. The jet has no alternative use. It's custom built for one buyer, and the contract guarantees the company gets paid for the work it's done, even if the customer cancels. Bingo, we're on the overtime track.
Okay, so our fighter jet builder qualifies to recognize revenue over time. Awesome. But that just leads to the next big question, right? How do you actually measure progress? I mean, how do you decide if you're 10% done or 12% done? The method you choose is absolutely critical. You basically have 2 main philosophies to choose from here. On the left, you have input methods. This is where you measure the effort we're putting in, things like labor hours or more commonly costs. Think of it like looking at how much fuel your car has burned. On the right, you have output methods. This is where you measure the actual results you're delivering, like hitting a specific milestone or delivering a certain number of units. That's like looking at how many miles you've actually driven. Both can be valid, but for these giant, complex projects, one is way more common. And this right here is the most popular input method by a long shot. It's called the cost-to-cost method. And the logic is actually pretty simple and elegant. You figure out your percentage of completion by taking the cost you've spent so far and dividing them by your estimate of what the total cost will be for the whole project. Then you just take that percentage and multiply it by the total contract price. That's how much revenue you get to book.
Now wait, did you catch the most important and most dangerous word on that last slide? Estimate. This whole beautiful, logical system is built on a foundation of human judgment. It's built on forecasts about the future. And that foundation, well, that's where we find the honest mistakes, the big errors, and sometimes the deliberate deceptions.
And the judgment calls, they start from day one. Under the US rules, you can't even start this whole 5-step journey unless you believe that collecting the payment from the customer is probable. And what does probable mean? Well, the guidance suggests it's a 75 to 80% likelihood. That's not a hard number. It's a judgment call that happens right at the beginning and can decide if a $1 billion deal even gets recorded. Now, what happens when those estimates go really wrong? Sometimes a project just goes completely off the rails. You realize that the total cost to finish is going to be way more than the customer is ever going to pay you. It's a guaranteed money loser. In the world of accounting, this situation has a very specific and kind of scary name: an onerous contract.
And you have to understand, the accounting rules here are absolutely brutal. When you realize a contract is going to lose money, you don't get to slowly bleed out that loss over the next few years. No, the moment you figure out the contract is onerous, you have to recognize the entire estimated future loss on your income statement, right now, today. It can be a massive, devastating blow to a company's profits all in one quarter.
So, because that rule is so painful, there can be immense pressure on managers to make sure it doesn't happen. This slide is a checklist of some of the classic red flags that forensic accountants look for. A manager might try to hide some project costs over in the general company overhead accounts, or they might conveniently forget to update their total cost estimate when something goes wrong. These aren't just little mistakes. They can be signs of someone trying to manipulate the company's earnings.
Okay, so we've got the rules, we understand the risks. Let's talk about how this stuff actually shows up in the real world. Because while that 5-step journey is the same for everyone, the scenery looks very different from industry to industry.
Let's take construction. A really common thing is that the timing of your accounting progress and the timing of when you actually bill a customer get out of sync. So if you've earned more revenue using that cost-to-cost method than you've actually sent an invoice for, that difference shows up on your balance sheet as an asset. But if you do the opposite, if you bill a client for cash up front before you've earned it, then you've got a liability. You owe them the work.
And here is another fantastic real-world complication. The rules you use for your investors are not the same as the rules you can use for the taxman. A small contractor will almost always use the percentage of completion method for their bank because it shows nice, smooth, consistent profits. But for the IRS, they're allowed to use something called the completed contract method, which lets them put off paying taxes on their profit until the project is totally finished. So yes, they are keeping 2 sets of books, and yes, it is perfectly legal.
So after this whole journey, through the 5 steps, the estimates, the risks, the real-world weirdness, what's the big idea? What is the core philosophy that drove this massive global change in accounting? At its heart, the goal is simple: to make financial statements that reflect economic reality. It's about shifting our focus from just tracking when cash changes hands to showing the actual value a company is creating and transferring to its customer as it happens. It's a move away from a simple, cash-based view of the world to a much more intelligent picture of a company's true performance. And that brings us to our final thought. The next time you pick up a company's earnings report, especially for a construction firm or a defense contractor or any business with these huge projects, ask yourself this one question. Am I just looking at a report of the cash they collected this quarter, or am I looking at a sophisticated, intelligent estimate of the value they truly delivered? Knowing the difference? Well, that's a massive step towards becoming a smarter analyst of any business.